Wow, what a panel. If anybody knows what's going on with these TASA changes, it's these 4 individuals with us today. Thank you, all of you, for joining. So now we will move into our first topic, which is going to be breach reporting and whistleblower provisions. Now, this is not specifically something that is part of the changes that we are going to discuss today, and they are actually items that are already in place. So from 1 July, we had additional breach reporting obligations applied to all registered tax practitioners, that's tax agents and BAS agents, under TASA. These obligations require tax practitioners to report significant breaches of the Code of Professional Conduct in the TASA, relating to both their own conduct and if we are aware of conduct by other tax practitioners. Now, Neville, I'm going to ask you the first big question. What is the threshold for determining whether a breach of the code is significant and if we have to report it?
Thanks, Rebecca. Of all the presents we received in December, this was probably the most unwelcome. I mean, having said that, the Tax Practitioners Board did the best with what they had to work with, which wasn't much. The TPB guidance on breach reporting can be found in their Information Statement 43 of 2024. Now, on the face of it, the threshold appears quite logical, relating to breaches that would be a concern to clients and the public at large. For example, an indictable offence, an offence involving dishonesty, a breach that results in material loss or damage, or a breach that impacts that tax practitioner's ability to provide taxation services. So the kind of things that clients are probably going to want to know about. Also, when assessing whether a breach is significant, you need to look at the frequency, because a single breach on its own may not be significant, but if that breach is repeated, then it may become significant. Now, as I said, the threshold appears quite logical, and in fact goes further in the TPB guidance, which states that if you're in doubt as to whether a breach is significant, err on the side of caution and report it. So fantastic. If you've got a breach, report it. If you're not really sure, up in the air, report it anyway. It's all good. The trouble is there's a sting in the tail, and that is that the TPB also say they may take action against the notifying tax practitioner, that's you, if they consider that the breach is frivolous, vexatious, or malicious, including having been made without sufficient grounds. So on one hand, if you're not really sure, report it, err on the side of caution, but on the other hand, if you do that, you may be penalised. So pretty much damned if you do and damned if you don't. So the takeaway really coming out of that is if you believe you've identified an actual or alleged breach by another tax practitioner, whether you decide to report it or not, document your decision-making process and your course of action, so when the TPB come knocking at the door, you can tell them what you did and why you did it. Thanks, Rebecca.
Thanks, Neville. That's really interesting and only slightly clearer than it was before. Susan, can you share maybe a little bit more information about the best practice for handling these breach reporting while still trying to preserve our clients' trust and confidentiality?
Yeah, certainly, Rebecca. So tax agents have sort of torn between two things. I mean, under Section 6 of the Code of Conduct, you can't disclose any information relating to a client's affairs to a third party without your client's permission, unless you have a legal duty to do so. And then you've got these breach reporting provisions that tell you have to report breaches of the code to the tax practitioner board and sometimes to professional bodies. So how do you reconcile those? Well, I suppose the first thing to note is breach reporting is actually about the tax agent, not your client. So when you look at the TPB website, you're looking at you having to put in details about the tax agent, and you're also having to describe what the breach is. When you're describing the breach, I suppose the first rule that you need to apply is redact information about the actual client itself. You can certainly talk about facts and circumstances without naming the client or having identification of the client in that detail that you put forward to the TPB or the professional body. Now, of course, you're probably going to get a question coming back from the TPB saying, give us a few more details, which client are you actually talking about? Well, when you get into that situation, you have to go push back onto the TPB and say, are you what legal requirement do I have to provide this under? And if they come back with the right section and you feel comfortable with it, then you're in compliance with Section 6 of the TASA Code if you actually do provide that information to the TPB. But, make sure that you are actually doing it under a legal requirement. So, get a hint of which section you're looking at from the TPB, get comfort yourself, and if you need to, get legal advice on that before you breach client confidentiality.
So it does just sound like we need to be really, really sure that we're comfortable that there has been a breach and that we understand what that is of. Now, on the right-hand side, there is a breach reporting form, which is the way that you would go about actually reporting a breach to the TPB. If you click on that link, that will take you to the form, and you can save that if you need that for future use. Now, Letty, are you able to sort of go through some of the common myths and debunk them around the breach reporting? Are we actively supposed to be out there with our magnifying glass looking for breaches in our day-to-day?
Okay, thank you for the question. So today I'll discuss 4 main areas of confusion that we've seen in the industry. So number 1, the start date of 1st of July 2024. Contrary to misunderstandings, you don't have to report breaches that happen before that date, even if they come to your attention after that date. You only have to report breaches that occur on or after 1st of July. So if you take on a new client and find a significant breach that the old agent committed, check whether it happened before 1st of July. Now, the exception to that is where the conduct first occurred before 1st of July but is ongoing after 1st of July. In that case, the board expects you to report the significant breach. Number 2, if you believe that you or another agent has significantly breached the code, fixing the breach does not get you out of the reporting obligations. You still need to report the fact that the breach happened. It doesn't matter that it was subsequently made good. Number 3, you don't need hard evidence or conclusive proof. You just need to have reasonable grounds to believe that a significant breach of the code has occurred. Now, the board says you don't have to be an investigator or an auditor or to go looking for breaches. So the answer to your question, Rebecca, is no. But you are required to have a sound foundation or factual basis, which could well take a bit of your professional judgment. On this note, if someone reports you, this doesn't mean that you will automatically be investigated and have a black mark against your name. The board will do an initial assessment first to make sure that it's serious enough for a formal investigation. If they think that the report is frivolous, vexatious, or malicious, they may take action against the reporter. I agree with Neville before. To protect yourself when you make a report, be sure to document why you have reasonable grounds to believe that the breach is significant. And number 4, the 30-day reporting time frame. This doesn't start from when the breach occurred. It starts from the time that you have or ought to have reasonable grounds to believe that it occurred. Even if it's past the 30 days, you're still expected to report, but you have to give reasons for the delay. Now, if you want to get legal or other expert advice before reporting, this is what the board says. If the advice is to help you figure out whether a significant breach has occurred, the 30 days starts when you receive that advice. If you already have reasonable grounds for belief, but you want a second opinion, then the 30 days runs from when you originally formed that view.
Thank you for clearing that up, Letty. That was very helpful. Now that we understand a little bit more about what those breach reporting requirements are, and we've gotten rid of some of the myths that have been shared online around them, hand in hand with the breach reporting is actually understanding what the whistleblower protections are. And Peter, you and I had a great chat about this before the webinar, and I'd love for you to go through what are the protections that occur, that exist under TASA, and also what are the gaps?
Yeah, that's an excellent question, Rebecca. It's, the whistleblower protection, little refresher is that in its purest form, it offers us identity protection and freedom from civil, criminal or administrative liability. So taking Neville's information sheet from the TPB, prominently displayed at paragraph 216, is a note that you may be covered by whistleblower protection. It actually includes a link to the TPB site for a list of those people who are covered by whistleblower protection. And that takes account of changes from July 24. It includes employees, officers, relatives, but missing from the list are peers. So your peers that may not be your business partners and what have you, unrelated peers in the industry and yourself. Now, so to be clear, if you dob in I'll say breach notified, dob in, use a terminology that you're comfortable with, but if you dob in a peer who is unrelated to you, then it seems there is no whistleblower protection. So if you witness behaviour that might be a breach, whether or not you've done much of an investigation, then serious consequences can flow from a breach reporting through civil action. Whether or not you're correct in your assertion, it doesn't stop the cost of civil action and litigation, which we know can be pretty significant and potentially not covered by insurance. So this is an area that we need to be extremely careful of. So in the case that you witness a peer's behaviour that may breach the code, then you need to think hard about the requirement to breach report. And then it comes down, in my mind, to what is your requirement to report. The TPB information sheet, I think Neville touched on these. There's a couple of key paragraphs in there, paragraph 39 and 40. 39 has an imperative there. It says you must, it's an absolute term, you must have reasonable grounds supported by facts and evidence. Must have. So that's absolutely, in my mind, black and white. Whereas paragraph 40, and Neville did mention it, is that if you're unsure, then just err on the side of caution and report anyway. So paragraph 40 seems to override 39. So there's an element of confusion between those two paragraphs. But if you absolutely don't have or reasonable grounds supported by facts and evidence, then you need to look pretty seriously as whether you head down this track, especially if you don't have whistleblower protection. So when you must have facts and evidence, that's an absolute black and white imperative term in my mind. And if you're unsure, pursuant to the to section 39, then be very, very careful if you tread further. The paragraph 40, as I said, it's when you take the decision to report or dob in, it's risky when you have no whistleblower protection. And as Neville mentioned, you can actually have the TPB take action against you for a frivolous, vexation or malicious report. What's one of those? One of those is one where it is trivial or lacks substance. That's sort of almost where you're unsure, isn't it? So that the terms that they've used in there leave you in a little bit of a dark place. And I think Neville touched on that. This is probably the one that gives us the greatest amount of angst. Probably one last point on a reporting thing there is where you are fairly sure that you might have breached yourself and there's an obligation to self-report, it's probably worth a phone call to your PI insurer just to make sure that you're not going to compromise any cover that might flow from it. I think Susan did talk about the fact that a client information could go along for the ride of a breach. If that becomes public, is there a chance for that client to have an action against you, or their information gives rise to a claim against them? So I think you need to, I think before I breach reported myself, not that I plan to, but I think I would be certainly touching base with a PI insurer. So
that's really sounded. Thank you for that, Peter. That's really important to understand that you do need to reach out to your insurer just to give them the heads up of what is going on. And I mean, these are all little questions we answer every year when we do our PI renewals, whether or not there have been any misconduct events anyway. So in every instance, keep them up to date. Now, moving along to the next topic, which is upholding and promoting ethical standards, which as tax agents and BAS agents, you think that we just have that covered. However, we've got some now firmer rules around what that looks like. Peter, straight back to you again. Can you explain to us, please, the importance of promoting ethical standards under Section 10 of the Code?
Look, this is a code item, so you'd be risking your registration by not complying with it. But essentially, you're required to uphold and promote the code, not undermine the public trust in the profession or the tax system at large, and not undermine the good work of the tax profession. The code item seems like a direct response in my mind to the PwC leak scandal, and to me, simply reinforces its action. Simply reinforces existing code items that you'll be needing to comply with anyway. So if you breach this section 10 of the determination, it's in all likelihood you've probably breached fit and proper person registration requirements or one of the pre-existing honesty and code items. So I'm not convinced myself that this section actually adds a whole lot that's not already in place in terms of actions, but it's sort of a little bit of a motherhood statement in my mind, but it sort of reinforces existing code items.
Thank you, Peter. And Letty, are you able to explain to us a little bit further then around Code 15 and what are the requirements under that code in regards to employing or contracting with disqualified entities?
Thank you. So firstly, I'll clarify that the disqualified entity rules are not part of the new code items. They were enacted way back in November 2023 and commenced on 1st of January 2024. The fundamental rule is that you, as a registered agent, must not employ or use the services of an entity to provide tax agent services on your behalf if you know or ought reasonably to know that the entity is a disqualified entity, unless the board has given its approval. The aim was to tighten up the rules so that people who have committed serious breaches of the code or other parts of the law can't easily just sneak back into the profession through another means without transparency and supervision. You don't want to be competing against someone who shouldn't be there. So what's a disqualified entity? It's an entity who is not registered and a prescribed offence has happened to them in the last 5 years. These prescribed offences are fairly similar to the ones which you need to disclose to clients under the new Code Section 45, including convictions for serious offences, penalties under the promoter penalty rules, and sanctions by the board. The rules cover both employees and contractors, so you can't contract your way out of it either. You don't need to have absolute certainty that the entity is a disqualified entity. You just need to take reasonable steps to check. In practical terms, this could mean checking the TBB register to see if they're currently registered or have had past sanctions, requiring disclosures in onboarding processes for new employees and contractors, and having staff policies in place which require staff to report these events to you if they happen to them. In terms of seeking board approval, there is a form on the My Profile part of the board website. You will need to explain what role you want them to perform and why their previous breaches are relevant or not, and the board has 60 days to decide.
Thank you for the update, Letty. It does just sound like this requirement's more around enforcing good practice in our profession and going through some better due diligence processes, which, whilst can be a little bit onerous, is probably better for us all in the long run. Now, moving into conflicts of interest and confidentiality in government dealings, I'm going to start with you, Susan. Could you run through a little bit more of Section 20 and around what the code says about identifying and managing conflicts of interest when we're dealing specifically with government agencies?
Thank you, Rebecca. Yeah, well, Section 20 was very broadly drafted when we first saw it, and the industry bodies all jointly negotiated to have it more targeted. It was actually, when it was first drafted, picking up anything that a tax agent would do with the tax office. It's now limited to activities that you undertake for a government agency. So it's meant to be picking up the contracting with a government agency rather than your day-to-day operations. So that's a significant narrowing of the provision compared to what it was originally. You also have to identify the conflict of interest that you have. So it's what your conflict of interest is, according to the legislation. We note that the TPB has still got it a lot wider than that at the moment, and that is something that the industry bodies would be negotiating with the TPB on going forward. Now, to do this, you actually need to try and provide some training to your staff on what is a conflict of interest. You certainly need to have procedures in your quality management system about conflicts of interest and how to cope with them. And you should be undertaking conflict checks prior to accepting contracts with government agencies.
Thank you for running through that, Susan. And we will now turn to you, Neville. Are you able to go through additional confidentiality requirements that are under Section 25 that extend beyond what we already have to do?
Certainly, Rebecca. So most of the new tax practitioner obligations that have been introduced over the last 2 years have been under the umbrella of response to PwC. However, it's the Section 25 that really goes to the heart of that breach. And in fact, if the government's intention was solely on addressing the PwC leaks matter, there's an argument that this section was all that was required. Now, putting aside the obligation to act honestly and with integrity, just a small code obligation, that's probably why it's number one, until the introduction of Section 25, a tax practitioner's confidentiality obligation under the code was to their client. That obligation has now been extended to include a tax practitioner's dealings with an Australian government agency. Of course, there's an argument that given that we do have act honestly and with integrity, even Section 25 was unnecessary. Unfortunately, the rules around the new confidentiality obligations are not as definitive as those concerning clients. In client matters, you must not disclose any information relating to a client's affairs to a third party without the client's permission. However, under the rules around whether or not information received from an Australian government agency is confidential, they use unhelpful phrases such as reasonable to conclude. So this leaves the registered tax practitioner with a judgment call to make. So the takeaway really is that tax practitioners in possession of information from an Australian government agency that they would like to share or perhaps use to make some coin should seek written approval from that agency before proceeding. And there is a bit of good news, unusually, but there is. The TPB have clarified that where a registered tax practitioner receives information from an Australian government agency, when engaging with that agency for or on behalf of a client, it would be reasonable to conclude that the information received from the agency was authorised for disclosure to the client. Now, that point was not always clear. In earlier iterations of the determination, it did seem that you were not able to disclose anything you received from an Australian government agency. Therefore, client comes to you, says, I need a repayment plan. You dutifully go off to the ATO and you successfully get that repayment plan, but then you weren't able to tell your client about it because you got the repayment plan as part of an engagement with an Australian government agency. So it's fantastic that we have that clarification from the TPB that interactions with agencies in your normal course of business on behalf of your clients can be disclosed back to your client. Thanks, Rebecca.
Thanks, Neville. It does seem like some of this was certainly rushed through without a lot of thought on what is going to happen on a day-to-day, but it is great that we've had a little bit more clarity in that area. We're going to move on now to addressing false and misleading statements. Peter, back to you again. Can you talk about what qualifies as materially false and misleading statement under Section 15 and give us some common examples of the risks that we have?
Okay, look, the way I boil down this section is that there's essentially three elements that need to be in place. Firstly, there's the false and misleading. So that equates to intent. There needs to be intent behind this. It needs to be material. I don't want to answer material at the moment because it's a bit of a nebulous calculation, but it's got to be large. And it's got to cause significant harm to others. So you look at the three elements, intent, large, and causing harm to others. Others also include the Australian government. So if it's collateral harm or significant harm to others, that can include the government. That's the preconditions before there's a need to raise a notification. But then only after you give the client a chance to rectify the breach would you need to go to that step to notification, and then only in the proviso that you don't fear for your own personal safety in making the notification in the first place. So there's a fairly high benchmark there as a steps to go through, and that sort of resulted in serious consultation with Treasury and the various associations, some of which are on the line here today, and it got in my mind a fairly common sense threshold in what it takes to make a notification, and it also encompasses the 8 standards. So as in terms of common examples, I don't think we're going to see many common examples. The head of the TPB came out and said, I don't think you're going to see many of these things. I think they're going to be rare, but when you see one, you'll know. I come up with an example. I just made one up, and I said, okay, well, let's think you've got an employer client who is failing on their super guarantee obligations. So it's got some, and deliberately so. There's also got to be the consent of a statement that's being made. Okay, so you need to extend on that to say, okay, what statement could be made that would be false and misleading just by not paying? Well, it could be that you've made statements through an audit, or you could have subsequently lodged false super guaranteed charge statements. So then you've got a false statement. If it's large, that could be a factor, and the employees who could have their superannuation entitlements significantly breached could give rise, in my mind, to something that you could need to report. Again, only if the client ceases to or fails to rectify the breach, and you don't feel that they're going to come around and knock on your door and punch you in the nose. So that would be there's my common example at this stage. Out of this whole section, I have a bit of a concern over the 2 different breach levels. We spoke earlier about the breach reporting of yourself and peers, and the fact that there seems to be 2 different benchmark levels here. You can see there's quite a high benchmark in client reporting, but when in doubt, dob in under the first section we spoke about, they're poles apart. And I have concerns over that from a few fronts, because it could confuse practitioners that they should be the same, and there's an argument they should be the same sort of thresholds, but it also potentially oozes out into the greater community and potentially give rise to a sense we're now in a dob-in culture, and which could undermine the professional client practitioner relationship. So I'd like to see them move those definitions so that they sort of almost in sync. So look, there's my concerns with that section.
Thank you so much for going through that, Peter. And it would be amazing if they could align those requirements just to make everything a little bit clearer for everybody. Susan, are you able to pick up then and let us know what steps we should be taking to correct the false statements if we find them, and what are our consequences if we don't comply?
Well, Peter, I'll be repeating a little bit of what Peter has said, because he did a very comprehensive review of it. So, first of all, as Peter pointed out, you need to have reasonable grounds that a statement was false and misleading. And remember, under the accounting standards, you're not allowed to make a false or misleading statement anyhow, and you're meant to correct it. So the TASA changes and the accounting standards changes are trying to actually reflect each other as much as possible. So if you've made a false and misleading statement in your own name, go ahead and correct it. If the false and misleading statement is by your client, then advise your client, sit them down, have a chat with them, tell them that it's false and misleading, what they need to do to correct it, and also what happens if they don't correct it. And as Peter pointed out, there are little carve-outs for the scenarios where, it's unlawful to do so. So if you've got a client that, we all know anti-money laundering is coming accountants' way. Under the anti-money laundering rules, if you're dobbing in a client to AUSTRAC, you're actually not allowed to tell them. And if they're doing something dodgy for AUSTRAC, they may be also having a tax aspect of that transaction that's dodgy as well. Under that scenario, you don't actually have to tell them that what's going on. And, you know, if you fear for your safety because you've suddenly got organised crime infiltrating your tax practice, you also got an out that way. But generally, you know, you sit down, talk to your client and get them to correct it, which I'm sure most people do every day with their client when they've discovered a mistake. If after a reasonable period of time you're not satisfied that your client has corrected it, then you need to actually think about withdrawing from your engagement with them. And that's the same under the accounting standards. So if you've got a materially false or misleading statement, you really need to think about your engagement with that client going forward. And as Peter also pointed out, if this statement is resulting in substantial harm to the interests of others, and we are talking substantial, which is a high level and what we've got in APES, then you may need to report it to the regulator. Now, obviously, failure to adhere to this code requirement is a breach of a code in itself, and it affects your registration, and it may result in you having to do a self-report, or one of your peers might dob you in if you don't actually fix it up too. So it does have serious consequences for not complying with it.
Thank you so much for going through that, Susan. Now, we're a little over halfway through the webinar, so we're going to move into record keeping and quality management, which is quite a chunky piece. We've got a bit to cover off. Neville, are you able to kick us off and talk about what obligations we have under Section 30 regarding our client record keeping, and how do these requirements actually interact with our client's own tax record keeping?
Certainly, Rebecca. The TPB's guidance on this new obligation, which is in Information Sheet 47 of 2024, expects that registered tax practitioners will have a clear understanding with their clients as to their Section 30 obligations and thus avoid duplication of record keeping. However, the guidance goes on to say that Section 30 does not absolve clients of their record-keeping obligations. So Section 30 does not reduce a client's record-keeping burden. But Section 30 and the accompanying guidance confirms that registered tax practitioners' record-keeping obligations extends to cover all aspects of the services provided, including the terms of engagement, advice given, decisions made, and client communications. So it doesn't reduce anything and potentially adds some on top. Now, there is a bit of good news, and that is that while Section 30 requires recording of all advice received from or provided to clients, the guidance from the TPB states that they do not expect registered tax practitioners to record every detail. For example, a file note about advice provided verbally is sufficient. However, and there's always a however it seems, the onus is on the practitioner to use their professional judgment in determining what records should be kept. So good luck with that. Thanks, Rebecca.
Thanks, Neville. I mean, to be honest, in practice, the older I get, the more file notes I'm keeping just to remind myself what I talked about. So it's really probably a good thing. We've had a lot of our information sheets from the TPB mentioned throughout the webinar. Just a reminder that they will be shared with everybody as resource items after the webinar has concluded. Now, Peter, could you talk about how ABN is guiding their practitioners and members to implement some better or effective record keeping systems, record management systems that are complying with these new requirements and also the requirements that already exist?
Problem. That's a good summary by Neville of the record keeping. It sort of was one of those ones that gave us great consternation with read literally before the 11th hour consultation. There was implied obligation to duplicate record keeping and retain them for 5 years and all sorts of impossible stuff. So I think it landed in a fairly sensible place. I'm speaking from a bookkeeper's perspective here for the moment, but existing checklists and work papers that would encompass their normal day-to-day activities would probably satisfy their obligations for most of the record-keeping obligations that they've got. There will be and we're going to continue to provide some guidance around that as time goes on. Look, and Neville did touch on, especially around the area of advice, where perhaps the record-keeping obligation may not have been as strong as it could be, or as is implied by the information statement. So, like as an example, a BAS agent's providing GST guidance on the application of the margin scheme on a property. So it's got GST implications, BAS provision. We'd be suggesting, that at least making a formal record of the advice provided, together with any supporting documentation provided or relied on, like rulings and cases and what have you. So you've got the complete track record of that particular piece of advice. There's an absolute requirement to have a documented QMS, which is a body of work that we're currently undertaking at the moment, and it's going to deliver a framework that's going to be able to be digested by and implemented by our BAS agent members. The important thing, particularly for the BAS agent community and probably the smaller tax practitioners out there, is that the information sheet, paragraphs 80 to 82, make it absolutely clear that the QMS is very much a horses for courses style approach. So what suits Beryl, the bookkeeper, may not suit KPMG. So there's going to be the ability to tailor it to suit. So it's not an off-the-shelf product. It's something that suits your practice, and QMS documents your services. So look, we have a body of work. It's out there, and there's some more on the way. So we will be keeping people informed in the lead up to the 1st of July this year, which is the operative date for most of our businesses, which are in the under 100 employee size. So that's what we're doing.
Great, thanks so much, Peter. Now, Letty, can you talk us through what are the new obligations under Section 35 to 40 regarding supervision and competency of services, and how does this extend to how we remote supervise anybody who does not work sitting next to us in the office?
Yes, so the rule is that you must ensure that there's adequate supervision given to each entity providing tax agent services on your behalf, and that they have the relevant skills to provide the services competently. Now, we could do a 1-hour webinar just on supervision and competence alone, but today we're just focusing on supervisory arrangements for remote workers. In the second half of the calendar year 2023, 1 in 4 accounting jobs advertised on Seek offered remote working opportunities. And for all those of us who didn't change jobs in 2023, our workplaces, for the most part, had continuous remote working arrangements in place. So supervising staff in different locations is now just a normal part of professional life, not just a pandemic necessity. Now, with supervision, there's really nothing like direct communication, but it often takes much more deliberate effort and planning when people work remotely and flexibly. You do lose the ability to just pop over to each other's computers for 5 minutes and look at the screen together. So regular scheduled check-ins are really important. Apart from team meetings, don't forget about the one-on-one catch-ups. It could be informal, and it could only just
Okay, Letty seems to have frozen. She might be coming back, but Susan, if you're ready, we might just move on to have a bit of a discussion around quality reviews and how they play a role in the ongoing compliance and making sure that we're keeping up with our obligations.
Oh, look, quality reviews are just essential to sort of have that background and that documentation there to make sure that you are doing everything correctly. I mean, I think the theme that's going to be coming through from this session is document, to make sure that you are actually in compliance with these codes. And quality management systems are, your guide of how to do this. I mean, chartered accountants, I'm pretty sure CPA, have all got quality management systems which our members can pick up and use and adapt for their organisations, including checklists and things like that. So we as an organisation do quality management reviews of our members on a regular basis to ensure that that competency standard is there. And quite often we find that people look at their quality management system and go, yeah, that's okay, and set and forget it. It's not something you can set and forget. You need to look at it and at least annually, but under APES you're meant to look at it updated for any new and regulatory requirements. And the changes that we've experienced in relation to TASA certainly qualify as a change to the legal and regulatory environment that we're operating in. There are quite a number of changes that will affect your quality management system. So you do need to update it now. You do need to, but just updating it now is not enough. You need to at least do it annually, and also keep an eye out for your organisation's newsletters, which will tell you of tax and regulatory changes that will affect your quality management system and doing it. And it's not just keeping it up to date, it's also living it. When we do our reviews, we find, sometimes the quality management system isn't quite documented enough, but also that, people have documented it, but they haven't necessarily implemented it or implemented it on a patchy basis. There's not much use having the greatest procedures folder if you just got it sitting gathering dust. You actually have to live and breathe it for it to really protect you and to make sure your practice is operating as intended. So yes, go to CANS, go to CPA, pick out those checklists, work out what your quality management system needs, and update those engagement letters. And, you've heard Letty talk about disqualified entities. I mean, that changes your terms of engagement of staff and contractors. There are differences in how you actually engage your client, and all those are captured in your quality management system. So that should be your number one priority in implementing these changes going forward.
Thank you
Letty.
for that, Susan, and welcome back, Letty. If you're able to just pick up where you left off, talking about the supervisory obligations, particularly with remote staff members.
Thank you. I'm not sure what happened there with our IT systems. I'm not sure where I left off, but I will just start from saying that you, apart from the informal check-ins and the regular one-on-one check-ins, you also need more structured and formal processes. So these could include a formal process for review, making sure that everyone on an engagement knows at what stage reviews take place and who's doing what. If a process is documented and detailed, then it's much less likely that something can slip through the cracks or problems be found way down the track. When I was a junior staff member and everyone worked in the office 5 days a week, we could use hard copy engagement planning and sign-off sheets in front of every folder. With remote working, you can instead use online project planners that are updated in real time. And once you finish your task, you can allocate it to the next person, but you still need to have a sign-off process. You also need to be really clear as to the scope of what people can do. For example, does a junior staff member need all their client emails reviewed before sending? Is there a difference between sending a form for signing versus answering a technical query? In terms of competence, apart from formal training sessions, also check what specific resources people need day to day. Perhaps a subscription to a digital tax commentary will help. Real-time feedback during or right after an engagement is also very helpful and much better than waiting for the next annual review. The board doesn't expect that everyone who works for you is trained in everything about every topic. If you never do transfer pricing work, then your staff don't need to be experts in that. The board just expects people to be appropriately skilled and trained for the work that they are doing. Now, another aspect of remote working is outsourcing and offshoring, which is, of course, a whole topic in itself. Ultimately, the key message here is that you can delegate the work but not all of the responsibility. Are the providers a registered agent themselves? Is there on-site supervision and review? Do they have a robust quality management system? How can you show that you can rely on the work that's being done for you? The board has also mentioned that we shouldn't forget about adequate training for admin staff for issues like conflicts of interest and confidentiality.
Thank you for that, Letty. It definitely sounds like this QMS process that we need to go through to continuously update is going to be completely critical to having adequate supervision across our teams as well. And if we do one well, hopefully we do the other well at the same time. Now, Letty, I'm going to stay with you and talk now about what are the most common compliance issues that the IPA or that you have seen that practitioners are facing, specifically in relation to their quality systems and keeping up to date now. So a lot of our requirements that we have or these changes are really just reinforcing requirements we should be adhering to already.
Okay, so I'll touch on 4 areas which we've seen across the industry where practitioners sometimes need a helping hand. Number 1, keeping up with the required CPD hours. We know that it's difficult to keep up with a heavy workload as well as make time for training sessions. Especially with online sessions, it is so easy to just say, I'll look at the recording when I hopefully have more time next week or next month. I've done that myself, and there's been times I didn't go back to look at the recording. Adding to that, if you're registered with the board, as well as being the member of 1, 2 or more professional bodies, then you're probably juggling a few sets of CPD rules to keep track of. Even though there's a lot of overlap, they may still be slightly different. So it's really important to stay on top of things throughout the year. For standard tax agent registration, you must have at least 20 hours per year and 120 hours every 3 years. It is a lot less painful to spread out these requirements so that it is just a few hours every month or 2 rather than leaving it all until the 11th or the 35th month. So check your progress every couple of months to stay on track. Also remember that activities like listening to podcasts and technical reading may qualify as CPD to an extent. You can listen in the car or read on the train, saving you time. I've done these sorts of activities sitting in a school car park. Number 2, another issue is maintaining an adequate quality management manual, which the others have touched on. I know that IPA members have access to our templates, which are compliant with TASA and APES 110 Code of Ethics. Investing time in designing a robust quality management system now will save you a lot of time and money sorting out unnecessary problems down the track. Now, leading up to 1st of July is a good time to update your existing manual to accommodate the new obligations, such as the necessary steps for false or misleading statements and government conflicts of interest. But remember that the manual can't be gathering dust. It needs to be used by your staff and updated for significant changes in your practice. Number 3, adequate professional insurance coverage. The board's minimum coverage requirements depends on your turnover. Business growth is something to be celebrated, and when you do jump into that next turnover bracket, just make sure you increase your coverage accordingly. Number 4, dealing appropriately with conflict of interest situations. This is another prime area for the quality management system to cover. Amongst other things, there needs to be a robust process for assessing new clients, onboarding new employees, and deciding how to allocate staff to engagements.
Thank you, Letty. And Neville, can you expand on some of those items as well and dive into what the CPA has seen as common compliance issues that practitioners are already facing in their day-to-day?
Certainly, Rebecca, and just continuing on with the theme coming out of what Letty has just said, the biggest compliance issue facing our members is time. The workload hasn't slowed down since JobKeeper, and although the ATO likes to say it's business as usual, the definition of usual seems to have moved. So the most common thing we're seeing is prioritisation of getting the work done over getting the paperwork done. Systems and processes are reviewed as time permits, which is not always as often as best practice requires. The client work is done, but there may be gaps in the documentation surrounding the services provided. The determination and guidance provide more granularity around what is required, but unfortunately they do not provide more hours in the day. And additional compliance burdens which add no value don't help. Thanks, Rebecca.
Thanks, Neville. Now, Ignition and CPA, IPA, and CANZ just over 12 months ago hosted a quality review webinar where we dived into the most common issues that practitioners are facing in regards to complying with quality review audits. There is some great information in that webinar. If you'd like a copy of the recording, please answer the poll on the side. We found that some of the highest issues were found in the engagement letters, quality review systems, and also in supervisory concerns. And now moving on to our last and one of the bigger topics that has been talked about, client communication and engagement letters. So what are the requirements under Section 45 regarding notifying clients of their rights, complaints processes, and practitioner responsibilities? there seems to be a lot of information we need to be regularly passing on to our clients and trying to understand the best way to get that to them exactly what it is what we're going to talk about now. So Peter, as these ongoing communication requirements start to kick off, how is ABN suggesting that their members handle that?
Yeah, look, this is another code item, Rebecca, that it ended up in a much better place than where it started. So the 11th hour consultation that they undertook with us had not some of the terrible obligations. There was an obligation in there to report anything that could affect the decision of a client to appoint you. Literally meant, health conditions, religious beliefs, and if you lived in Melbourne, it was probably your AFL team of choice, all sorts of things. Anyway, common sense resulted, and it was flipped. So now the obligation is to report two categories of things. Those things that are about yourself that the client should know, and they're really the absolute nasties. They're the things that a client should know. Things about restrictions on your registration, terms of jail, fraud, dishonesty, convictions, those sorts of things that are absolute disclosures. And secondly is a whole pile of things that the board would like your clients to know. Perhaps maybe you could arguably say this is actually the board's job, but there's an obligation to disclose those things as well. So how we've advocated doing that is main method is ultimately it's the client's choice. They can do it as they choose, but our profession has really taken a serious track on their onboarding, and engagement letters are they're commonplace. That's probably the most universal way of initial contact with a client. So we've taken the tack that the engagement letter is probably the logical place. The TPB actually helped with the process. They produced a thing called a fact sheet, which actually had all a list of the things that they'd like to tell your clients. So from the engagement letter, we simply reference or link to that TPB fact sheet. So you're doing your normal engagement letter. If you happen to be in jail for 6 months or more, you can disclose that as well, and you link to their fact sheet. And it's just in the normal business process they would otherwise adopt in onboarding a client. So we find that works. That fact sheet was actually quite good because it would overtake your engagement letter with your client. You're better off referencing to it in our mind. Could do it from your website, do it from all sorts of places, but engagement letter sort of fits our profession best as we see it. We updated that engagement letter before Christmas, and that's now available for our members to grab and to use as they choose. So yeah, look, that's pretty well where we're at. But there's any number of ways you can skin this cat, and at the end of the day, it is the client's choice as to how they undertake those disclosures.
Thank you so much, Peter. Susan, CANZ have updated their engagement letter. I am an FCA, so I am already using the updated guidance, which is fantastic. How often, however, should practitioners review and update their engagement letters to ensure not just ongoing compliance with these TASA obligations, but also our current obligations?
Well, Peter has touched on a couple of things that you need to tell your clients about. I mean, going back to your general accounting standards, best practice is to update it at least annually, but you should also consider updating your client engagement letter whenever there's change in your client's circumstances, in the changes of the laws and regulations, the term and scope of engagement, or there's third-party recipients of client information. You certainly should be looking at your engagement letters and possibly updating them then. But then with the TASA overview, I mean, if you were convicted of a serious tax offence or became an undischarged bankrupt or convicted of an offence involving fraud or dishonesty or sitting in jail for 6 months, as Peter has mentioned, you should be looking at your engagement letter there to make sure that your clients are actually aware of what's been going on.
Thank you, Susan. Now, Neville, CPA have also ensured their engagement letter addresses these items and that we have that process of updating our client communication. In addition, CPA is also building a checklist to help practitioners self-assess when they need to send an update to clients. Can you explain that a little bit more for us, please?
Certainly, Rebecca. So as Peter summarised, where Section 45 landed is not anywhere near where it started. So it now has a nice prescriptive list of disclosable events that the tax practitioner must tell their clients about. So we've embedded the checklist into our engagement letter so that there is a paragraph that says, I've got nothing to disclose under section 45, and I would hope that everybody on this call will be using that paragraph. After that, every disclosable event listed in section 45 is included. And unfortunately, if the first paragraph doesn't apply to you, then you simply cross that out and leave in the one or more disclosable event that does apply to you. Now, if you're doing that annually, if you're renewing your engagements annually, and as Susan said, that is the best way to do it, that's reminding you of what you have to disclose to your clients, and also bearing in mind that you only have to disclose those events that occurred in the last 5 years. It's also reminding you of what may actually drop off your engagement letter as time passes. Thanks, Rebecca.
Thanks, Neville. So that annual re-engagement process is a fantastic opportunity to remind us what we need to do and to just also comply with best practice as recommended by everybody. Now, Letty, what key risks arise when engagement letters are actually outdated or non-compliant? I know early on in my career that I relied on engagement letters that could be 10, even 15 years old, which is really scary, and they're not. We didn't update them very often post that initial contact. What risks occur when you practice that way?
So I'll start off by noting that the IPA is also in the process of updating our engagement letter templates. We're doing this because we see up-to-date engagement letters as a critical part of practice risk management. Without an updated engagement letter, firstly, you risk not meeting the new Section 45 obligations to disclose certain information to your clients. While it's not compulsory to disclose them in an engagement letter, the determination does say that you'll be treated as complying with the rule if you make the disclosures on your website and in your engagement letters. So you can just do it all in a standard document that you're sending out anyway, rather than spending extra time and money sending out the information in a separate communication every time. You can also risk your clients not understanding how the new rules affect them, especially the possible consequences if they don't correct a false or misleading statement. More broadly, beyond TASA compliance, an up-to-date letter will help you to protect you in commercial disputes about fees and scope, or what everybody has agreed to do, or what information to provide. For example, you need to let the client know that they have a legal obligation to maintain records. Now, even though your professional association may have templates, it's very important to make sure that you customize them to be fit for purpose for your specific practice. For example, if you outsource some work or if you use external experts.
Thank you, Letty. Now, engagement letters is the key item that Ignition can actually help you with to stay compliant, not only with our TASA updates, but with our general tax agent and BAS agent requirements and suggested requirements around client communication. If you would like a copy of Ignition's Guide to Engagement Letters, please tick the poll on the right-hand side. Yes, it is a fantastic guide, goes into a lot of detail around what our requirements are under ABES and TPB and the new TASA requirements, along with suggested wording, and is a very valuable resource. Now, before we close out this webinar, I would like to just ask all of our panelists for their final key takeaway. Susan, would you like to go first? What should we be focusing on?
Documentation, documentation, documentation. Make sure your quality management systems, and particularly your engagement letter, are up to date and you are living the spirit of those documents. And make aware, you've got so many resources available to you. All the industry bodies and Ignite have all been saying to you, we've updated the templates, we've got a quality management system, we've got an engagement letter, we've got the tools to help you choose which one's the right size for your organisation and your firm. So get on board, use them, protect yourself and protect your business.
And Peter, how about you? What is one item that we should all be addressing in our preparation?
I guess it's the fact that we've got some time here, particularly for those employee numbers under the 100. Actually, I've just got a prod from our marketing department to let me know that the engagement letter we spoke of earlier has been updated in the Ignition system, so it is embedded. Look, the legislation we have here was shaped a lot of the little bit of last-minute consultation with Treasury and Association to get it close to form. The breach reporting stuff was forced through without consultation, and it shows. I guess the thing to take away from here is that associations are working extremely hard at the moment to get digestible information out to you, and it will be flowing, I think, thick and fast from all associations, as well as some ongoing consultation with these documents that have only just arrived just before Christmas. So it's a pretty active 6 months, and keep in contact with your associations is probably the message I'd advocate.
That's great. Thanks, Peter. And Neville, last but not least.
Rebecca, firstly, just to reiterate what Susan said, document, particularly in relation to Section 15, if you are faced with a false or misleading statement and a difficult client, whatever you decide to do, document it. Also, just with regards to Section 45, and I just previously mentioned, as we all did, about the prescriptive list that we now have, just remember that if the code obligations apply to you from the 1st of July 2025, you have under the transitional arrangements until the 31st of July 2025 to inform your clients of all disclosable events that have arisen since the 1st of July 2022. So you're not going back 5 years, you're only going back to July 2022. And then finally, pretty much parroting what the others have said, you're not alone. Your associations are here to help. So if you're in doubt, reach out.
Thank you so much, and thank you all for today. It's been really, really fantastic content.